So the thing we were discussing as well was exhaustion, spotting it and understanding what's going on. So this is a prime example of an exhaustion. My ink seems to have decided it doesn't want to work again. Okay. Right, so I'll get that. There we go. Right, in business. So this was the Euro one from the other day. This is the big sell-off on the PMI data. Now, there is no way I would take this as an indication of what PMI data can do. This is created purely out of a market that has just got pushed so far, it has hit a big stop. Bearing in mind, the Euro's come off miles since the election. I can't remember what price it was. It might have been at 112, something like that. So we've come off to these lows, the best part of 800 ticks. In a currency, that's a big deal. So effectively, it gets pushed far enough that someone big really does actually have to give this one up, and that's what happens down here. So one of the sort of questions asked, I'll place a bid down there as an indicative of the low. One of the questions asked was around like staying in a position. This is your moving average. That's a 1 minute EMA. I know people use a variety of different ones. This would be a situation where if I'm in this move, I'm not waiting for an EMA to get me out. I'm looking for something on the ladder, and the best thing you can see if you're short here is an exhaustion. If you see an exhaustion, you can say to yourself, this is the low, at least for a period of time. After an exhaustion, this is a 1 minute and this is a 60. After an exhaustion, you will typically see quite a hefty pullback. How big it is, who knows? Whether it goes back to the low, who knows? But you are likely to see a pretty hefty pullback. So we go and have a little look at the ladder, and then I'll explain the sort of theory around that in a bit more. It's ticking down, it's got a bit of pace in it. Trade 60, there we go, trade 60, trades mid 40s. What you start to see here, there's lots and lots of volume getting done at 50. So this is kind of your sort of panic selling. It's not quite a sort of full on slam it down exhaustion panicky type move. But as soon as you start to see this would then be a point where I'd be thinking, whoops, if we start to get above 50, we're all good, this is going up. The hard bit in practice is when precisely do you buy this, and is this it? What can happen here is it absorbs, and if the selling starts coming in again, it will go for the lows. That would then be the point where I'd be thinking, yep, this is all good now. We can go towards the upside on this one. You can start to try and add in. So what the idea behind the trade here is, you've got to a point where the market has effectively just washed out any longs. Anyone who wanted to sell had to just get on with it, panicked and sold. So you've run out of the sellers. For more sellers to come in, think about it, if you don't have a position and you've just watched the Euro do, well, from here to here, you've just watched it do the best part of 0450, 70 big ticks, and then it's done another 40 in a straight line, you're not selling down there. Nobody's doing anything that stupid. So as it starts to bounce, it's going to be quite a long way before you actually find any new sellers. This is why after these types of moves, you will almost always get a bounce. The only way this was not going to bounce was if these sellers here pinned it enough that then they push for another leg of stops, and that could happen. So that's kind of the danger moment there. If it's going to go, it needed to hold 51 and it would go for the lows. But on the back of these types of moves, you will typically get quite a nice quick reversal. First point of call on a reversal like this would be the top of that candle that created the big spike down, so that'd be 82. That'd be the first point. You could then start to look back all the way through this previous drop and play that all the way back up.
Is your ladder tick compressed, is that why?
Yeah, it's only on a half, yeah. Yeah, so this would look even faster if you had it on the full tick.
So just 2?
Yeah, it's just 2, yeah. But if you had that on uncompressed, this would look double quick as well. So it'd feel much faster, that move would feel much bigger, it would kind of accentuate it. I'm a big fan of buying these types of exhaustion moves on the basis that you're going to get a quick bounce back. With the really extreme ones, I view it as it's a percentage trade. You don't know where the low is. That was slow enough that you could do it, but with some, they will just go flash down the page. My strategy on that is you just buy it at market. You have no idea where you're going to get filled buying that, but because people are selling, you know it's probably going to be relatively close to the low. The other thing is you have no idea where your stop is because you don't know how far they're going to push it down. But the idea is once it flashes down the page, that probably is the bottom of the move. So if you click at market, if you're unlucky, it's bounced back far enough before you actually click that you're buying quite a long way off the low. If you get really nice, and this is luck more so than anything, if you get the timing just right, you end up buying virtually the low, and before you know it, it's come back, something like this. What you're playing for there, the reason I call it percentage trade, 90% of those types of trades come back, and they come back a big way. 10% might not, probably less than that. I'd say probably 5%. You will typically, in any exhaustion like this, have enough time when it flashes down that it will bounce it to a degree. If it's going to go again, what will typically happen, this is sort of very micro level, you'd almost need a tick chart to see it. It will do this, that, and then it will either go up or it will go down. Once it starts to form this little range here, the bit that you can see, which the euro did, but it did it slower at 50. If it comes out of that to the downside, get out. Even if you ended up buying it here, don't hang around on it, because if you do, and this does the same thing again, you're miles offside before you know it, and it will flash down as well. So you won't be able to go, oh look, it's trading down, get out, before you know it is off the screen. And you don't want to be in that situation. So there is still a chance that you can get away with it, even if you do buy it and it doesn't. Yeah, there was that example we did on oil where it did that type of thing after some news.
One question for when you're getting into that trade, Richard.
Yeah.
Is there, given the market conditions, is there an increased risk that your stop is now behind everybody else's stops who's already there in the market? That will be triggered before yours, right? Because you're adding a stop to the queue of stops.
Yeah, which is why if I'm trying to buy the flash down, I won't place a stop, because you run the risk that you then get slipped on your stop miles. I'm buying that on the basis that I should almost instantly be on side, which will give me 2 or 3 seconds to make a decision whether I stay in. Right. And if it starts ticking back down, before it even gets to the low, I'm going to get out of that, because if it goes through the low, it's probably going to do the same again. Right, okay. I've seen it happen a couple of times. It's definitely happened against me in the DAX. It sort of flashes down 50 ticks. You go buy it, and it sits there for a second. It flashes down another 50. Well, logically you should buy that as well. So you buy it, and it sits there, and it flashes down another 50. And you're like, I can't really do anything now. I've probably got to get out of this, and it sort of bounces a bit. You have to just get out. Then you go home. I remember that day happening once. Literally 2 of us, me and my mates, next to each other, and we came in here. So it was on the open when it opens at 7 o'clock. So it only used to open at 7. It opened at 7. It did that flash down trade. Buy it. And literally 2 minutes past 7, we both went home. That was the end of the day. Because you've gone past your stop, and so you got a message saying, then we'll trade in for you, and you go home. That's the risk of that trade. But on the whole, most of these trades will flash back at least enough to give you a moment to think. And as long as it doesn't start ticking back down, it should go back, and generally will at least retrace the initial flick down, and quite possibly as a low. We were talking about this as well a minute ago. With something that extreme in a currency market, you would say the one market I wouldn't do this with is any commodities. Commodities seem to have a tendency that they could do that, pull back, and tomorrow they'll do the same again. They don't seem to have a great deal of, don't know what's the right word for it.
Respect.
Yes, yeah, they're pretty uninhibited. Commodity markets, they will just go nuts. That gold one the other day where it dropped like 500 ticks, you think surely it's not going to do that again. It does another 500 on the day. I've seen gold do this type of thing and do about 300 tick stop in 2 seconds. So it's got the scope to do those types of things. Commodities are bad. You don't often see a stop move that big in currencies, bonds, anything like that. If you do, there is one way of sort of thinking about it, is you could look at that and go, do you know what? I reckon I've got the low. And when I say the low, you're basically buying the bottom of the wick on a daily candle. So you could look at that and genuinely say to yourself, I've got the low for weeks here. And it wouldn't surprise me if you have. If you look at where the euro is now compared to down there, you could have just sat on that. What you have to do with a trade like that is you have to sort of mentally go, right, I'm buying whatever 2 lots for the whip back, buy 50, get out in the mid 80s, and I'm buying 2 lots for the big one. In which case, those 2 lots, once it's bounced back into the mid 80s, you put your stop below the low and you leave it and forget about it. You have to accept that if you're trying to play the I've called the low of potentially the whole year, you could see this all the way back up here and you can't move your stop. You've got to just put your stop here. I've got this and it's going to work. Perhaps at some point there may be enough, but I'd almost use a daily chart to decide when I'm going to move my stop. Like it's got to break for a previous daily support that had been broken. If it gets back above that, then you can move your stop. But you have to be willing to accept that you could see an enormous swing in your P&L on a trade like that. But you're playing for the the 1 in a year trade that you've actually got the low. If you do it with say 2 lots, if it works, you can make 20, 30 grand off it. Yeah, well if this is going to rally back 10 points, 20 points, there's a lot to be had on that. But these are very extreme. You won't see many of these at all. The last one I really remember in the pound was what people call the flash crash. It wasn't the flash crash, but it was the massive flash down in the pound post Brexit. Not Brexit, but it was like a few months later, and I think it traded like 119 or below. If you bought the bottom of that, I think you'd still be on side. It never went back. So you get those types of scenarios. There's always a story is, someone had a 100 lot bid and they got filled. And these are the kind of things that happen around Christmas time. You'll get on like the 28th of December, some kind of insane 100 tick stop in, I don't know, the bobble. And somebody's left a 500 lot bid and they've got filled and it's bounced back 100 ticks on them. Wonderful for them. And that's what gets people thinking, I'm going to trade Christmas. And the thing is, if you're trading that, you're not the person with a 500 lot bid. Why are you going to be selling the bobble and that happened to be the one that does it? Because I pulled the bobble out, it could be anything, corn, something like that. And also in the moment when you're sitting at home on the 28th of December and nothing's going on and bobble falls out the sky, are you really going to be the person who goes, I'm going to buy that and hope it bounces back? Because if it doesn't, it's going to be a horrific feeling for you and you shouldn't do it. And you're sitting there going, I'm chilling out at Christmas and I've just taken a 5 grand loser on a 2 lot because it didn't bounce back, because there was actually some news behind it. So it's just one of these things that attracts people in to do that kind of thing, or people get attracted to that kind of thing, and it's usually rubbish. I think the S&P did something massive on Christmas Eve last year. Did like 100 handles, like straight line down. You're never going to sell that because you won't be looking for it, and you'll get 15 handles on site and be like, brilliant. Yeah, 15 handle winner, very quick, fantastic. And then it goes another 80. You're not going to be buying it, or you'll probably buy it too early and lose your 15 and another 15, and then you'll kick yourself and you wonder why you bothered. So the long and short of that, after the 3rd Friday of December, the rollover, generally just go home until January is the general strategy. Very few people would stay for anything past that. And the only thing last year was the Bank of Japan was on the Monday afterwards and people stayed for that, and that was it. And I don't think that went well. It was a bad end to the year. So there you go, that's kind of a proper exhaustion type movement. You won't see many of them. You see the occasional one in bonds, in currencies, equities. Try to think of one in equities, because even like the COVID lows weren't that, because the COVID low was limit down, so you never got that. And then you got unlimited QE. If you bought that, you could still be long. The only stimulus that didn't come back. Right. So that was that one. So a question, I mentioned a few books by Pinker and Waitskim. What am I reading on prospect theory? Don't need to go into huge details on prospect theory. You need to understand the concept more so than anything else. Thinking Fast and Slow, which is by Daniel Kahneman, is fantastic. I will add a few others on here because I know that there's a few that I haven't put on already. Thinking Fast and Slow is brilliant. It explains prospect theory quite a long way into the book, and it's a big book. That's really, really good in understanding the way that you think. For me, a lot of books that I read are generally not about how to trade and technical analysis and stuff like that. I want to better understand how I think, how other people think. So psychology books I think are really, really good to read. Thinking Fast and Slow gives you a good basis of actually understanding kind of how your brain works and the way people think. Particularly it talks about like brain 1 and 2, essentially is the way they sort of distinguish your sort of logical side versus your emotional side, your conscious, subconscious type idea. There's another one that gets talked about a lot, which I can't think what it's called, but it uses the concept of a monkey as your kind of chimp paradox. Yeah, that's good. Does the same kind of thing. It describes it in a slightly different way. So anthropomorphizes it a little bit more than just talking about your brain and the science. I prefer Thinking Fast and Slow personally, albeit Thinking Fast and Slow doesn't suggest ways to get over the things that affect you. It's more just about explaining the way that people think. Blink, as I said, I'll stick on the list as well. Traders, Guns and Money and Extreme Money are really, really interesting in terms of Traders, Guns and Money to understand derivatives, complex derivatives. It's not going to massively help you trade, but it helps you understand what's going on broadly within markets and how people are doing whatever they're doing, what exactly they are doing. So it gives you that kind of perspective of, you know, who you're trading against and what those people are doing. Extreme Money's the same guy's follow-up book, which is more about the individual, so more about the way people do stuff rather than the just derivatives. The first one's sort of very complex derivatives. The second one relates a lot to the financial crisis and various crises and how they were formed, what sort of fed into them, that side of stuff. Rationality's the Steven Pinker book. I think that's a really, really fascinating book about the way people think and why basically people aren't massively rational as much as you like to think you are. The one thing I'd say about that, whilst it's extremely interesting, he's clearly an extremely smart guy who likes to let you know he's an extremely smart guy with the usage of some of the words. And Pinker in Rationality, it's one of these books that you had to read on and you still weren't sure from the context what that word meant. There's quite a few words I actually had to look up what the meanings were. So just bear that bit in mind, but great book. The Art of Learning is really good about sort of how do you actually take stuff that you've done and actually learn from it. You look at the cover, it looks a bit self-helpy. The good thing about the Art of Learning is there's actually a lot of the things he describes a process for how you actually overcome difficulties, how you actually learn from stuff rather than a lot of self-help books that here. Just accept it and be mindful of these things. For me, that doesn't work. You can't just be mindful of stuff. You need to actually do something. That's got a fair bit of process in it. Make It Stick is about learning processes and things that you have to, things that can improve the way you learn. That I think is really good. I don't mean you need to read loads of it. You don't need to sort of read the entire book. Probably the first 2 or 3 chapters and you get the concept. The concept being essentially, you're not going to learn a great deal by just going over stuff again and again and again, because all you'll do is you'll remember the easy things that you remember from previously. What you've got to do is force yourself to recall stuff, and in doing that you recall it so much better, and also you highlight what you don't know. So if you, I always suggest this at the end to people when they're going back through the material, don't go back in order, first day, second day, third day, fourth day. 1, it will get boring, so you won't really take on anything, and 2, you're not already doing anything apart from just kind of reliving something. And it'd be like watching a film back. You kind of, you know what's going on, so you don't concentrate as much. If you randomize it, pick things almost completely at random, or just go, right, I'm doing stuff on profile, I'm going to pick the 3rd day of profile week. What you want to try and do is summarize, either if it's just in your head or you write down the basic principles or the basic things that you can remember ahead of watching it. By doing that, 1, you forced yourself to recall, so you've probably embedded that information far better, and 2, when you watch it, you'll pick up on the things that you didn't remember. Same as a film. If you go and watch a film and you kind of rerun the story of the film in your head before watching it, you'll pick up all the nuance in the film that you didn't notice the first time. So that's the basic concept around it.
How long do we have access to the course?
It's typically 2 months. That can be extended, so just send an email to Info Axie Futures and you can extend it, which also answers someone else's question, I think. I'll throw a few other books on that list as well. So I haven't put the authors on it, but I can't imagine that you'd find many repeats of those books that are different to the originals. But yeah, I'll try and fill that out a little bit more detail for you all. So that'll be on there. What I'll also do, possibly on this sheet or on another one, is I'll put some links to a fair few of those Evernotes that I referenced. So sort of various different links to different things that you might find useful. So I'll whack all of that on there rather than me going through them all and then trying to share them. So what will happen is they disappear on the chat group and then you don't find them. Okay, general execution question. When you try to enter a position like in your initial balance break example from today's video, are you just entering limit order on the offer anywhere below current offer? Is that the most effective way of getting in at market during fast moving action? Yes, that would be my suggestion. I'm going to get this out of the way and I'll show you. It's going to be very hard for me to go, oh, look at this quick move. This is where you click. But yes, in essence, that's what I'm looking for. This is the S&P, which is obviously extremely quiet just at the moment. In fact, it's literally just about to open, so you might get a bit of speed. Yeah. So if the plan is really open in 25s, really open in the middle of nowhere. But yeah, if your plan is on the open, you're going to buy it. What I would do is, yeah, absolutely, hover your mouse above the bid. What you're doing by doing that is, and this is the whole idea of a limit, you're limiting how far you're going to pay. So if you click there, which is 27, you will get filled on whatever the lowest offer is below 27. So if it happens to go tick, tick, tick up, then you're going to get filled 25 3/4, 26, wherever it's trading, but you won't get filled above 27. If you use the market button and this has suddenly jumped and it's trading 32, you're buying 32. And you may not want to be long at 32, so that's why you don't use it. That is the most effective way of doing these types of things. It gives you control. It means that you're not sort of, particularly on anything that you think is quick, the last thing you want is to join the offer if you're trying to sell. Because if you think it's going to be quick and you join the offer and get filled, that in itself is telling you it's not quick. You really don't want that. It probably suggests that you're wrong. So that's when you don't want to do it. In this instance, if you were still looking at 27, you'd then be on the bid at 27. Oh, annoying. Turn the replay on, it's gone away. You'd still be on the bid at 27. Whoops, 27. There you go, there you get it at market if you click it like that. So yes, if you expect something to be quick, you have to go and hit it at market. If you wait on the bids and offers, you're not going to get filled. I wouldn't expect this to be particularly quick today at all because it's Thanksgiving, but yes, absolutely. That also brings about a concept around sort of understanding what goes into the execution of a trade. If it's, let's say a really clear level, you're trying to play the breakout of the IB, for example, you've also got to consider the fact that there's a lot of other people that are probably looking to do the same thing. That means there's huge competition for fills. What this implies is that the market's going to move quick and that you possibly are not going to get filled at the price that you want because there's enough other people who may be that little bit quicker to click than you are, a little bit more aggressive, a little bit more keen. If that's the case, then you have to kind of accept you may need to pay up a few ticks as well, which is also why you'd hover your mouse above the bids so that you kind of go, right, I want to buy 27.5, but I'm still happy buying up to 29. That way you mitigate the risk that you go 27.5 and somebody's beat you to it. And if they've beaten you to it, it's gone now and that's it, move over. So you have to sort of think in those situations, how far am I willing to go to get into this trade? Obviously you don't want to go bananas on it and sort of go and try and hit market at 50, because if it jumps through the area, you're probably going to end up buying the top of a move that is probably then going to pull back. That's literally the exhaustion move and you've sold the low of it or bought the top of it. Never what you want to do. On which point, I've mentioned this before, people always complain about these types of moves, like market falls down now, oh no, I got out of the low. I always get stopped out of the low and then it bounces. The thing that's happened there is you've not got stopped out of the low and nobody was trying to catch you out and the market was not waiting for you to stop out personally. It's never personal. What's happened there is this is dropping really, 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 really quick and you're trying to click and you don't really want to hit market, but at some point you're going to. And usually what happens is and this is that nuance type of thing, at the low is the exact point where the market has stopped going down. It is now moving slowly enough that you can actually click, because previously it was just zipping off the screen. So now that it's actually slowed down, you go click and that's the low. And it's not because it's trying to catch you out of the low, it's because it's slowed down enough for you to actually click it. In reality, probably what happens often is you're actually selling it as it starts to come back up. It's hit the low and it goes tick, tick off the low. You don't really see that and you go and click and it feels like you've got stopped out of the low or you've hit the low to get out. And it's more to do with the fact it's finally actually basically letting you do it by not moving away from you too quickly, which is almost always the low. It's just it's hardest to do that to buy, because to buy it always feels like it's getting away from you. And then when it bounces, by the time you've gone, oh, it's hit the low, it's bounced 10 ticks and you don't want to buy it. So it's always easy to sell the low in those situations. But yeah, don't be frustrated by it, except that that's what happens. The other thing with stops, when people's stops get triggered at the low, it's probably because as a short-term trader, you bought it here and you placed your stop about 10 seconds before it broke the low. Everybody else who's got the stops that are going to create the big move, their stops have been there for days, weeks. So the order that stops get triggered is based on the order at which they get placed. So if someone else's stop has been there for a week, they're probably the first stop to trigger. Their stop triggers, pushes the price down to here. That triggers a load more stops, which now trigger. Market keeps going. And eventually your stop triggers, at which point there's very few people left. And nobody else is selling it. The only people selling are people's stops. So once your stop's triggered, which is probably one of the last ones entered, there's nowhere left to go. and it bounces back.
When the stops are triggered, there has to be somebody buying that. If you're triggering a sell market order, right, then somebody has to be buying that.
Yeah, just any passive bids that are there, it just hits them. And so what happens, because it's so instant, it wipes out the first few bids, and then the next stop hits the next bids, then the next ones, and no one's quick enough to place a bid. Which is why it feels like, it feels like it's almost instant, the drop.
It's creating almost like a mini vacuum in the bid and offer, in the spread, that then has to then jump straight back down to fill that vacuum.
Yeah, absolutely. Okay. And then as soon as it stops that move down, then anybody who wants to buy then hits their bids in, and it refills the bids basically. But it swipes them all out. So for a very, very short moment, you basically got a bid here and an offer here, and that's it, and it's just swiped them all. And then everyone fills them all back in. And that's what will happen. Which is also partly why you generally, when it does bottom, you get quite a quick move back up, because anybody wanting to buy is now scrambling and trying to hit, and there's nothing to hit because that offer has only moved to here. And so now you get that chase back up, and then everyone kind of calms down, and then we're back to normal. Unless it goes too far, and then you get a volatility stop, and then it has to settle down that way. All right. I'll move that over there just in case anything excited happens. Based in Australia, yes, it is the last week. Would you be able to take questions after? How much time do I have access? Okay, simple, I just mentioned this. You've got 2 months after. Send us a message if you want any extension to that. The other thing, yes, I can answer questions afterwards. Just bear in mind, there's probably a lot of other people who are perhaps going to send questions as well. So don't assume you're going to get an instant answer. One thing also, I'm going away tomorrow, so I will not be answering any questions to anybody before Friday next week. So just bear that in mind. But that gives you a bit of time to actually think about them. If you can answer it yourself, wonderful. But if you do have any questions, no, always fine if you want to ask anything. Okay.
Trading related, okay.
Sorry?
Trading related?
Yeah, keep it trading related. You probably don't want my opinions on lots of things, and I'm probably not going to give them. Depends what the question is. And I'm going to get a load of really bizarre questions, aren't I? Do you prefer pandas or dogs type questions? Okay. Few questions here. So, measuring trade performance. Evaluating results against expected rewards is an arbitrary price target to compute profit. Is counterintuitive to me. Well, the thing there is, you've got to look at it and say, well, any trade has an expected reward, right? If you get in here, that's your expectation. So my view is, whether it reaches here is effectively, there's 2 reasons it doesn't get there. One, you got out of the trade too soon, in which case the result is still that. It still goes there, and you got out too soon, in which case you can then go, well, what caused me to get out? Or the other one is it doesn't get there because you've asked too much. You need to work out what that is. If you've said I'm selling it here and it's going here, and you don't get out there, either it never went there or you got out too soon. And you've got to then work out which of those things you commonly do. Either it's an analysis problem or it's a psychological problem. You've got to work out which one of those it is. That's why I think you should have a expected, and a target shouldn't be arbitrary either. There should be a clear reason why you're looking for a certain point. And that's also part of the question, what is the reason for looking for this? And what you're trying to understand there as well, is that the right thing to look for? This is why I don't like I'll just let it run type trades, because you have no real way of measuring whether that was a success or not. You just let it run and you end up going, well, that was a decent P&L, so it must have been a good idea. Doesn't justify doing that every time. What's your thinking regarding MAE, MFE as a metric for evaluating how well the trade was managed? In terms of the way the trade was managed, yes, I like that. For anyone who doesn't know, MAE and MFE is maximum adverse excursion and maximum favourable excursion, i.e. you've sold it here, how far offside have you gone before it went onside? So that would be your MAE, that distance. And that would be your MFE to wherever you got out of the trade or wherever it went. What this is helpful, you have to compare this to what you actually took on the trade. It was helpful for you to understand, are you getting out, if you get out at target, then your P&L should match your MFE, as in number of ticks on side. If you're letting it be a runner, chances are your MFE is much bigger than your P&L in ticks. And the other part of it is your MAE. You want to understand, are you taking an outsized risk on a trade? Something in terms of learning initially, don't place a stop and check your MAE on trades to understand on the ones that are working, how far offside is realistic, so that you're not creating a stop that's based on 5 ticks or whatever. If you take a trade in the S&P and your MAE on a certain type of trade is typically 8, then that's telling you how far you should be willing to see it offside in order to get the results you want, rather than just going, well, I don't like more than 4 ticks, so it's a 4-tick stop. But if it does more than that almost every time, then you can adjust your stop, or you need to adjust and adapt your entry point. So I like MAE, MFE for evaluating sort of how well you are doing at actually getting the trades to where they need to go and how much risk you're taking on a trade. Yeah, what you never want to see, I've seen people with this before, is they've got an MFE of 30 and they've got a P&L of 1 and an MAE of 10. So basically you let it go offside, let it go onside 30 ticks, and it's come back, you've taken a 1-tick winner. That's not good. That's one of the things you don't want. In general, your MFE should be bigger than your MAE, and you shouldn't have any kind of, if you just looked at a list of your MAE and MFE, you shouldn't have anything that's like huge standout on the trades, really. You're generally going to be looking for reasonably similar trades. If you see this with people as well, that it's very good for sort of judging newer traders. They've got an MAE of like 10s, 15s, 6, 12, 3, whatever, 70. Well, that was clearly a trade where you just went, oh, I'm going to hope it comes back. That's the kind of thing you don't want to see. You also don't want people who have got a huge MFE and a relatively tiny P&L, because what they're doing is they're letting it run, and it does this and it goes down, 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 down. They get out there basically because they've just let it come back, and now they don't want to take a loss. Your mentality goes around oh, it's just a pullback, it's just a pullback, it's just a pullback. Oh no, I might lose, get out. That's what ends up happening. That's why you need to have as much as you can say it's arbitrary, a target of some description. Even if it is purely arbitrary, it's got to be something that you can go, well, if I get there, I'll get out. Recognised profit as a percentage MFE would reveal how much was actually extracted from potential of a trade. Isn't measuring profit of an early exit against predicted target simply a form of FOMO? I should have been paid more. No, I don't think it is. Because if you're looking at your profit compared to an early exit, or sorry, your predicted target, if the market went to that target, you're back to this. Why didn't you take it to there? It's not FOMO, it's being realistic that for some reason the market did exactly what you said it was going to do and you didn't participate in it. That's something that you need to get to work out why you're doing that, because you should be earning a lot more.
It's also helpful for something I learned was that there are price patterns in range extension, right? So how far a market moves, and learning, okay, well, how far did the market go after I got out? What's the thing like, if you look at it through the lens of what's the information I can learn about how I'm managing my trades, that actually the market tends to go 20% further every time in these circumstances, therefore I can extend my targets.
Yeah.
Actually more range, rather than seeing it as which is a very valid point of seeing it as a FOMO thing.
Yeah, no, you're right actually, and that was also the other side of it that I didn't point out, that if you're getting this every time, you want to go and look at what happens next, because actually you might be doing yourself a disservice. Like you say, if it goes 20% further than your target every time, well, you want to be looking for 20% more. I think what I always try and look for, and it's rare that you actually have a situation like this where you're looking for a number of ticks, but on trades where you're looking for sort of a number of ticks, I try and sort of see what the sort of range of them is, so that I can go, well, I can always get 20. Some are going to go a bit more than 20, but I can guarantee 20, and then use that as my point to go 20, and then I scale out after 20. Just to guarantee, if you know that you'll get 20 every time, you go for it. But yeah, absolutely, I want to see that side of it. So yeah, I wouldn't see it as FOMO at all. I'd see it as basically as a deficiency. You expected one thing, market did it, and you weren't part of it. That's a problem. That's something that needs to be addressed. Mini versus micro, is the difference in the personalities of mini versus micro, specifically NASDAQ. While arbitrage might keep prices aligned, it seems that each instrument appeals to a different size of trader, which might affect price action. Does one lead or lag the other? If there is any kind of lag, even if it's in like an untradeable amount of time, the micro will lag the mini. The mini's the main one. So for almost everybody, anyone who trades a micro, at least here, will chart the mini, and you trade off the mini chart and you trade the micro off that. Where you see people trading micros a lot is where they're trying to take a more directional trade. So something they want to try and hold for multiple days, they'll do it with micros so that they can scale out in smaller increments. So on the whole, I don't think there's a great deal of difference in the way that they actually trade, because any difference that you might see will get arbitraged away. You will generally see slightly less flow in the micros, simply because they're being dictated by the minis for one, and also there's less volume. Where you've got this a little bit less so, excuse me, I've referenced this before, is the mini and big DAX. Because the mini and the big DAX basically trade about the same amount of volume now. So they do have, both of them have got, well, neither of them have got a great amount of flow, but they do have sort of individual characteristics. But yeah, with the micro NASDAQ or an S&P, I'd say basically it's just a mirror of the other, or it's not a mirror, a copy of the other. It's one of those, if you didn't realise you were looking at a micro ladder, you might not notice a great deal of difference.
The one thing you definitely do see, like in the ES, I'm looking at the micros versus the E-mini, is the volume patterns that drive the price action in the mini are obviously not the same as on the micro ladder. So when you watch the micro ladder, you can watch it for execution, but actually if you're watching the E-mini ladder, that's where you're seeing the flow that's ultimately affecting the price.
Yeah.
Like you're seeing bigger bids and offers and stuff like that happening, you're just not seeing on the micro ladder. So you can sometimes miss some of the nuances.
Yeah.
If you're not watching both.
So that's a good point. I would, if you're going to trade the micros, put a mini ladder next to it, so you can just sort of see the action in both. So no, I don't think it makes a great deal of difference. Tilt indicator. Do you see any value in the tilt indicator Top Step provides, which shows the percentage of their traders which are long versus short, the average entry price, those holding positions both long and short, the percentage of those in a position long and short, and what are positive versus negative? I don't see how that would help me in the slightest bit, because all that's doing is telling you about a few traders trading via Top Step, who are, without wanting to be disrespectful, not big traders. You know, if a few of them get out, is it going to even move the price a tick? Probably not. The other thing is, what am I going to gain by knowing that some people are long and some people are short? That would be my prediction anyway. No, I think it's, yeah, that's something that's been created that seems to offer some information, but I don't think it would help. If you had one here and it said, oh, look, half the people are long and half the people are short, still don't know what you gain from that. The only way anything like this would be useful is if you, well, no, because who are you going to trade against? The people who are long or the people who are short? So, which is what you're doing all the time anyway, just on a bigger scale. The only way something like this would be useful is if it was specific to a trader, because then you could understand the patterns of trades that they do and the things that they do. But knowing that some people are long and some people are short, the people who are long initially may now be short. So what you don't even understand is whether a certain type of trader is now short versus long. You just understand that of the number of traders, some are now short and some are long, but they may be the same people or different people, which is essentially the same as just looking at a price ladder. And at least with a price ladder, you see everybody. So no, I don't think that offers anything personally. If you're really kind of stretching it, the one thing you might sort of see from it is that, assuming most people are more retail-y, generally, and this is a massive generalization, but a generalist rule, that retail traders get long at the top and short at the bottom because they're momentum based and they're short term. That applies here. You know, more people are going to be long S&Ps as it moves towards highs than they are going to be short. So, and it's not necessarily even retail, it's sort of day type trading. That's inherent in the way that people trade. So again, it might help you a little bit. What it would help you with is if you know that almost everybody is long, what this tells you is if it does start to turn, the turn's going to be probably more dramatic because people are going to have to run for the exits. So there's something in it to a degree, but I would say not.
So all those people have got their own reasons for which you've got no idea of why they're long and why they're short.
Or where they're long or short from.
Yeah.
Either, if someone's got long at the top of the move, they're probably more inclined to get out. Someone who's been long from down here is probably waiting because they've got a target somewhere up there. They're not going to do anything. So what you need to understand is people's motivation to act. That's what you really need. If you understand what their motivation to act is, which is no way quantifiable, they're not filling in a form going still long, still like it, don't like it, then that's going to tell you something. But otherwise, I don't see what it can do.
And it never accounts for responsible initiative participants who are not yet in the market, right?
Yeah, and they're probably even more important.
Like to change the direction of the market.
Yeah, what people are about to do is far more significant than what people have already done. Because once you've bought, you've got it now, and you're just waiting for a point to sell, at which point that could have zero impact. You put your offer and you wait, and that's it. Yeah. So no, I don't really think it offers very much. Is one thing that you do get published every Friday is the CFTC COT report, the Commitment of Traders report. and that distinguishes people who have to report positions and where the sort of balance of different types of participants is. There's a lot of sort of theory around it. You go and read up on it. It basically talks about the difference between hedgers, retail, basically. It distinguishes all different types of traders. Generally, people hedging are always the wrong way. So if the hedgers are buying, it's probably going down. If the retail is selling, it's probably close to the low. So you start to get a situation where hedgers will buy, retail starts selling. That would theoretically indicate that you're perhaps near a low. Just appreciate that this is done over the entirety of the previous week and is then reported on Friday. So it's a week late in the information, but you're building up a bit of a story or a bit of an understanding of what's going on.
Isn't it where like when the funds are accumulating or something like that, it's trending one way, but then when they stop taking their positions, it's supposed to go reverse, something like that.
Yeah, so what you're trying to get from that, it's a bit like longer term, more detailed delta, that it's basically showing you, if you've got huge positioning one way in treasuries or whatever, the natural inclination there is that it should go the other. Because if everyone's long, the next logical thing is they have to sell. I referenced it earlier, it's the GameStop situation. That once all the retail people got long together, they became the hedge fund inadvertently because they were the only people long. They can't sell to anybody, and the hedge funds are not going to give them a bid because they're short.
What happened to GameStop? Did it go to zero? Or?
No, it stayed up, but it's nowhere near the highs. It never became the biggest company in the world like some people thought it might, with some of the crazy prices that people called on it. It doesn't work out. If you do the maths, it would never get to those prices fundamentally, but people don't grasp it. And GameStop was a great illustration of people misunderstanding the mechanics of markets and the fundamentals behind why stocks are priced what they're priced at. It could never have reached some of the prices that people are suggesting because you just can't justify a company of that value. I guess theoretically it could if people just keep on buying, but who's actually going to do that?
There's only a certain number of...
Yes. Okay, so this is Darius as well. I'll try and sort of read it through quickly. Reposted this, it didn't go over. I didn't see it on my email, Darius, so apologies. Maybe it was there and I haven't seen it. Pattern of notes pieces is somewhat inspired by the trader. I asked you to break it down the other day, although I've not tested it per se. Provide an impact in chart example within what I had available. Right, okay. Candle one should not close very near the top of its range. It should not be a hammer candle. It should also not be a doji. It should be outsized red and without a large wick at the bottom. Okay, so a candle that looks something like that. Okay. Should not show any aggressive buying imbalances, especially towards the bottom. If they are towards the top, then they've clearly been broken through. Trade is okay, be cautious throughout that it does not find support just above the initiative if it does go quickly. Very aggressive buying would be a large disproportionate number on the ask side, which is a relatively big number for the market being traded, even in bullish conditions. Okay, that's a subjective thing, which is fine. You just need to know what that is. Could be a single or a set out balance of 30s, 40s, then someone aggressively buys 200 all at once. Starting on heavy absorption, candle one invalidates. On candle two should be a signal to immediately take profit. The second exhaustion candle should ideally not rotate more than halfway back through candle one. If so, it should be approached with caution. Okay, so what I'd say here is that you're very specific on some things and then suggest approach with caution. You want to turn this into a definitive. If this goes more than halfway through the previous candle, what are you going to do? Don't approach that with caution, approach it with action. Like get out or stay in, whatever, but do something and be clear what you're going to do. After rotating about 2/3 of the way back, I'd estimate the probability of trade playing out is much lower. I've not tested it as this way or played it enough to be confident about the probability. So it can be scaled in as candle two rotates back or a passive entry attempted on preset level. If it rotates too far, stop above candle one, or two, look for a reversal indication to close with a minimal loss. Not the original take profit or simply break even and get out. Yeah, there seems to be, I'd say here, lots of options of things to do, which whilst there's a description of it, it strikes me as something where it's like, well, it'd be cautious, but it could be this, it could be this, it could be this, and therefore make a decision, which suggests a kind of general, well, see what happens and then call it. You want to be much more specific. Candle 2 rotates up, assuming the primary trend is down immediately or near immediately upon opening, and should then exhaust up and continue down. It does the opposite, continuing straight down before reversing up. The trade is invalid and rotation back should not be taken as an entry point. Okay, I'm slightly confused precisely as to what this one does personally. I'll try and understand this from the images. Right. Oh goodness. Right. So it's really difficult to see. So that's your take profit. You're entering here. Okay. Yeah, I think it may be one, Darius, that I'm going to have to look at and then try and answer rather than try and work it out. It's an extreme delta exhaustion footprint pattern. Right. I tell you what, I might have to just read through this one and try and work it out and then answer. And then what I'll do is I'll post it in with the rest because I feel like I'd end up just standing here trying to work it out. Right. Richard, how do you name or consider personally the different changes of the market? For example, balance, imbalance, and trend 4 days up or down. I just want to clarify concepts I learned with the footprint course about 2 years ago. When we talk about liquidation, we're selling in a trend up and buying in a trend down. Okay, so maybe this is not quite the explanation you're looking for, but I'll try and explain. Yeah, right. Okay. How do I consider different stages in the market? For example, balance, imbalance, and trend 4 days up or down. So my general kind of way of viewing markets is you will move from a balanced market to an imbalance, balance, and then it can imbalance and balance. That's how I view a market's general movement. This doesn't have to be a specific number of days, and this is fractal. So this could be a 5-minute chart, this could be a daily chart. The principle works the same, that you'll move through periods where the market doesn't have a great deal of direction, then it will be clear, then it won't be clear, then it will be clear again. So each of these balance periods view as neutral in direction. When you come out of it, the direction is established, which is maintained until you then start to get this. So by sort of this point, if that doesn't go, this then becomes a balance area. It now balances. 4-day trends, if that's the sort of question there, it can happen. I wonder if this relates to what people will call a 3 crows or 3 soldiers pattern. So soldiers go up, 3 basically big, large days up, crows go down. I know that originally they were crows because when charts were black and white, the black candles went down, so they were called black crows. And I don't know why soldiers on the way up. They needed a name. So soldiers on the way up, crows on the way down. That might be what you're talking about. The general idea on something like this is usually the next day is a doji, or at least a not particularly directional day. On the basis you don't get 4 days in a row up. I'm not a big fan of this kind of mentality. My view is if the market's going to go up for 4 days in a row, it could do 5. Why not? Yeah. Or I'm always of the view, don't be surprised if things do something that's slightly surprising, because at least then you're not surprised by it. That's probably comes from when I started. That if you start in 2008 and the market goes down 2% and people go, surely it can't go any further, it almost always did. So my view is, well, why won't it go any further? So that's one bit. Cover concept out on footprint course about 2 years ago. When we talk about liquidation, we're selling in a trend up and buying in a trend down. Yeah, you can have liquidation either way. Generally a liquidation will come out of some sort of balance period. Often you will get a liquidation which is counter trend. Think the post-election trade where you had the S&P up, consolidate, liquidation down. Liquidation is the main part of being able to spot when a liquidation is going to happen, or at least foresee the potential, is when you feel you're getting quite clear positioning. If you go and look at that election move, Everyone buys on the election and the day after. People then buy for the continuation. They're wanting this. It doesn't happen. So you end up with lots of people long in here, lots of people building up long positions in here. Sellers, anyone short down here gets washed out, so they were a buyer in this move up. Some people will be selling here. But if you think of the weight of buying, you've got buyers here and buyers here. So you've got double buyers and one side of sellers. And let's face it, sellers aren't going to be super keen selling up here either. Once you start to move down, the sellers are right. And because you've only got sort of one measure of sellers, they can now sell more. And now all of these buyers, at least these ones, are wrong. They start selling. And then as it comes down, the people who bought over here, now they start selling as well, which is what creates the liquidation. You see the same, you saw the same recently in gold when it did this kind of thing, when it just went like that and drops. That's also a pretty common liquidation type pattern. Flip those over and you get the same the other way. You can get liquidations that continue, sort of a continuation one, which be, there's an example of this in the Bund, but they would perhaps be ones that you wouldn't be so sure would stay within the day. So you can get a liquidation that then fails to keep going. There was one that was referenced earlier, I think the 7th of November possibly, where the Bund basically did the move down. And it's been coming off for a while, and then it does this, and it does liquidation, and it turned that back within the day, but you would still get a liquidation move. So that's what you get there. So liquidations don't have to be counter trend. More commonly they are counter trend. It does always depend on the sort of size of trend that you're looking at as well. So hopefully that's answered that one. I have no idea about ICT concepts, Joe. As far as I know, that guy's, not to be disparaging, but has a reputation for being something of a scam artist. That's all I've heard on it. I have no idea on some of his stuff, but the one thing I have seen is the concept around, what's it called? Risk management and rapidly cutting risk to alleviate effectively ever burning your account out, on the basis that if you reduce risk, your account effectively does that. So it tends to zero, but it never reaches zero. Your job as a trader is not to stay in the game and not lose money. If you don't want to lose money, put it in the bank, because you're still losing on inflation doing that. And in fact, you're just whittling down. So one of the concepts it talks about is basically you can afford to lose 20 trades in a row and it's only going to drop you 15% of your account. Great. If you could lose 20 trades in a row, one, you shouldn't be able to afford that because you shouldn't be trading. Yeah, like if you can lose 20 trades in a row, you really probably shouldn't be trading.
It's quite hard to lose 20 trades.
Yeah, balance of probabilities.
Proven by yesterday, right?
Yeah, exactly. You could come in and close your eyes and click and not lose 20 trades in a row.
Yeah.
So you shouldn't. It's playing into the fear that people have. So people follow some of the ideas because effectively it plays into their fear that, oh no, I could lose everything. Yeah, you could. And that's something that's really important to remember. You start a trading career in the same way as if you start a business. Your business may not make it and it will go bust. And your trading career can as well. And I think if you can't accept that and your goal is to not to lose money, you're always going to put yourself into a position where you're not going to make money. You know, no one opens a restaurant and goes, ooh, buying steak's expensive, despite the fact that this is a steak restaurant, so we're not serving steak because you don't like the outlay to start with. You have to have the outlay and then get the customers to come, and accept that if they don't start coming, well, unfortunately, you're going to go out of business. The quicker people accept that, and this is not to sort of say, oh, you're all going to fail and it's all terrible, but if you don't accept that you could fail, you probably will. And what will happen is you will just bleed like that. And because you try not to lose, and eventually you run out of money. You're better off to give yourself a chance and go out in a blaze of glory. I'm not suggesting everyone just punts payrolls full size the first trade they ever do live, but you're better off, if you do fail at trading, to have failed because you had a go, you genuinely gave yourself a chance. Otherwise, all you've done is just whittled away some money, which you could have been more wisely used somewhere else. You could have just bought SPY with it and you'd be better off. So just think about that. That's a really important thing to kind of mentally deal with, that this may not be for you as much as you may want desperately to be a trader. You may not be able to do it. In the same way I had to do that with football. Not that I was that good anyway. I wasn't even the best kid in my class, let alone school. So I was never going to be a professional footballer. But in sort of going, just forget that dream. You at least go, well, I don't really care. So I go and enjoy playing football.
That's the best way you can put it, but you said that perfectly.
Right. Raoul's question, did you say that a stop market order has priority over a market order in the queue? Is the position in queue for a stop market when it is placed or when it is triggered? Okay. There's no real position in queue with a market order. When there's a series of stops, so let's say, yeah, these are your price levels, right? If you've got a series of stops, so you've got multiple stops on this level, right? These stops will be triggered in the order that the stops were placed. So if my stop was the first stop placed, that will be the first one placed. Someone who hits market, if there is a bid here or here, you will hit the bid because those stops will not be triggered until someone hits market. Once the stops have triggered, they will trigger almost instantaneously. So they've not got priority, but they will click faster than anything else because they will trigger instantly. So in a sense, they will beat you to it, but they will beat you to it on the basis that at the moment it triggers, the trade is instant. So unless, well, no, you can either be the person who triggers the stop or the stop hits market and then you're the next trade after that. So that I hope kind of explains that there's no queue position, but the order in which the stops were placed, i.e. registered on the exchange, is the order in which they'll be triggered. So this stop will be triggered last. And if the first stop takes out this price, this price, this price, the second stop takes out this price, the third stop will trade this price. That's how you get slipped, because other people's stops trigger before yours. If on the way down, there is another stop here, this stop will get triggered after the third one up here, because these are already triggered. So that's market sell, market sell, market sell, market sell, which comes afterwards. So as they go to the exchange, it's like sell, 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 sell. That one will then sell this price down here. That's the order they were going. The only way you'd be able to hit in between that is if you manage to hit before this stop gets hit, i.e. you hit one of these prices, assuming that the total of these stops don't take them out, but the stops will be triggered instantly. So there'd be no sort of delay in the stop, so you wouldn't be able to trade within the group of stops being triggered. At least those stops triggered at the same price. So hopefully that answers that one. I think that's probably everything, unless anyone's got any other burning questions that are spilling out and they want to ask. Grimey's typing. Grimey's always got one typed right at the end. I'll let him get on that one typed. Okay. Right, I'll leave that for a minute. What I will say is thank you very much. It's been enjoyable. Thank you for the questions. In summary, what gives you a bias for a day? In summary, what gives me a bias for the day is a 60-minute chart and a profile, broadly. That's essentially where it comes from. That sort of sets out what I think is going to happen, what I think the potentials are that can happen, and of those potential things I think that can happen, my bias will lean towards whichever I think is more likely. So that's a bias. That bias will change. If it goes past a certain point, that bias will switch immediately to sell rather than buy, for example. So that would be how I describe that. So yeah, hopefully that's short enough, brief enough summary for you. I will wrap it up there, guys. Thank you very much. It's been enjoyable. Thanks for the questions. Thanks for the input. Great work. Hopefully everyone's learned a fair bit. I'm always around. You can ping me questions, like I said earlier. Just appreciate I may not get back to you immediately. Anything specific course related that you need to know, or technology related, extensions, etc., ping a message to info@CFutures. You should also have an email for the link for Alex's session tomorrow via Zoom. So I have just been told that that email has been sent. So you should have that, which will detail the time as well. That's probably about it from me. I'm never quite that great at this sort of final goodbye. What I did find recently, and this has become my now final end, is a quote from Stanley Druckenmiller, which I think sums up trading, at least from a short time frame perspective, despite the fact that if you don't know who Stanley Druckenmiller is, he's a hedge fund manager. He worked for Soros's quantum fund. He was basically the guy behind the 1992 Black Wednesday trade, and his view of basically, you've got to bet the farm on this, which sums up day trading, basically, that it's not about ticking along. It's about preserving capital whilst you're ticking along and then shooting for the home runs. That's really how you make money. You know, most people who have been successful in this have been successful off a very small number of very big days. Yeah, when I say a very small number, relative to career. You know, if you've had a 10-year career, you've traded 2,500 days. They probably had 300 decent up days, and that will account for more money than the totality of the 2,500. The rest of it is just ticking along. That's the preserving capital. The other bit is then going for the home runs. Don't try and be consistent on a day-to-day basis. If you get a chance, if you see the opportunity, you go for it full steam, and that's where you'll make your money. So there you go, a little bit of inspiration for those of you going forward. Alex will be on tomorrow. He will see you probably around midday UK. From me, that is all. Thank you very much, and hopefully we'll see some of you guys soon. There you go, that's all right.